Before we get started with today's show, I just want to take a couple minutes to talk about permissionless for the next conference presented by Blockworks. It's happening in June 24th to 26th in Brooklyn, New York, and it's all for the developers and builders in crypto. So if you're interested in really understanding how the nuts and bolts of the crypto industry are being built and you want to learn more, go ahead and get your ticket. I'm going to be there as well as with Quinn and the rest of the Forward Guidance gang. It's going to be a ton of fun. So use the code FG10 at checkout and you'll get 10% off your ticket. So really looking forward to seeing you there. Prices are going to be going up pretty quickly into the lead up of the event. It's only a couple months away. So be sure to act real quick there to get the best deal. All right, back to the show. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. All right, welcome back, everybody, to another Roundup edition of Forward Guidance. And what could be the last time that it's just Quinn and I chatting together, just us two this week. There are hints of an old friend returning to join us next week. Back again. I won't say who, but I will say to keep an eye on the Vietnamese dong for any price action there. That might hint at it, but don't want to get too carried away. But there is a very strong chance that this is the last one for a while. That's just going to be Quinn and I. But yeah, I'll leave that at there. You'll have to tune in next week and see. But yeah, what's going on, Quinn? How's it going?
Yeah, not much. Nice to always get through another of the most important day in weeks since the last FOMC. And there's a whole lot of nothing as expected, I think. And now we wait and see until more fake China headlines come out, or other trade deals, or if there's a war first, or we'll see.
Feels like a whole lot of everything and also a whole lot of nothing this week compared to the last few weeks, where it just feels like we had almost too much to talk about. But yeah, we're recording about half an hour after the Fed press conference just ended. And, this meeting was going to always be a bit of a snoozer. It's not a dot plot meeting, and everybody expected no change to the Fed funds, that they're going to pause. So really all eyes were on the press conference to get a bit of a gauge on whether there'd be any sort of hints towards a June cut or even certainty around a July, and just what that path would be. And yeah, I got a couple tweets and reactions from a few people in terms of just parsing through the Fed speak. And yeah, Nick Timrose had a few points, as he always does. But yeah, a key point Powell mentioned is that inflation is rising while unemployment is going up, which isn't a choice we currently face. This would be a complicated and challenging judgment that we'd have to make. So I find that definitely interesting, is that we even saw this in the statement change, where they basically said that risks have increased for both unemployment and inflation risk, which is extremely rare for them to highlight risks in both sides of the direction. Typically, you would expect it to be sort of one or the other. So that's just really hits the nail on the head on how nuanced the situation that we're in right now is. But yeah, that was really interesting. Warren Pies, who's a regular guest on the show here, mentioned that his overall view was that all three inflation vectors, oil, labor, housing, are dormant. However, the Fed is not going to do anything that might facilitate the transition to higher tariffs. Continued shift from proactive to reactive Fed is a net negative for markets. So we'll pull up these other ones here in a minute, but I want to pause there and yeah, just get your high level take, Quinn. It feels like, typically when you get nothing happens in an FOMC meeting, that could, sort of see as like a reflex, in terms of bullishness. But due to the fact of where we are with the economy, it sort of feels like nothing is hawkish in a way, especially when you're going into a meeting where the June pricing was pricing like a 20% odds of a cut in June. I think July is something like 60%. So just based on where the Fed funds forwards is pricing versus the result of what we got, which is a whole lot of nothing, the market needs to mechanically probably unwind those odds of at least a June cut. So just by doing nothing, it feels like that's somewhat hawkish. But yeah, what was your take?
Yeah, I agree. I didn't really have super high conviction as to which way the press conference or minute or statement would lean, other than not significantly in either direction, and that it doesn't really matter for risk, because I think they're purposely delayed here. So exactly, totally agree with what you said. He didn't come out swinging to send a hawkish message. He just said that they see the data as it is, relentlessly harped on a strong economy, and how they think it's still solid, and that they just need to see the effects of these tariffs, which we saw as the market priced out June down to 23%, July's at 86%, and then September's after that. But yeah, there's just the data is, maybe without the tariffs, would say maybe they would think about easing soon, but I don't think they're going to have the clarity they need on tariffs by June. So it sounds like that's probably a no, unless something falls off a cliff.
I think we're both on the same camp that June is pretty much a write-off now. It's either the jobs report next month has to be just so bad, talking like probably like a 20 bips increase in the unemployment rate, at least, to get them moving on that side of things. And, it's really interesting. Like, I had Neil Dutta. I just interviewed him, who's just such a wicked economist. And he's, he was the one who was fading the recession calls in 2022, when I think 100% of economist surveys were saying guaranteed recession. He was right on that. And now he's pretty worried. And a lot of that comes from the labor market. So he sounds a lot more concerned from Powell, who's still talking about maximum employment. So yeah, it's really interesting to see that dispersion there. So it feels like it's setting up this continued tension that we keep talking about on these roundups, which is that just the lack of proactiveness. And this was something also that was mentioned in these tweets here, which is, they do not want to be proactive in any sort of way. And what was really interesting too is that he emphasized that he felt like the 2024 rate cuts in last fall weren't preemptive either, which is surprising to me. He said, if anything, it was a little late. Don't know about that one. Do you?
At least one cut, right, was late. That's probably true. But to barrel through with 100 after things were fine after one in September, that was over the top. I thought Warren's tweet was interesting because it almost implies some politicking, which I think everybody can agree. I don't think they're egregiously maybe doing it, but they all clearly have their opinions on tariffs being really bad. So, or some form of disagreement. So they, as he mentioned, they don't want to do something that allows for a more seamless transition. For me, every meeting, and it's becoming, it appears increasingly likely that June, unless something really horrible happens in the markets or economy, which I don't, we'll see. It's becoming likely that with each meeting that they go with no cut, the odds of a slowdown that impacts corporate profits and earnings and stocks, I think is becoming increasingly likely.
It's interesting. It feels like the continuation of what we were talking about last week, of this mirage in the hard data that will continue to remain resilient, is pretty much right off the cuff of the press conference. Powell was talking about how he was referring to PDFP, which is just basically like a way to talk about core GDP in a way. It nets out net exports. It cuts out government spending. It just really gets to the nuts and bolts of the growth of the economy. And he was saying that, that was just as strong as it was last year at this time. It's completely, the negative printed GDP that we got was complete noise from the import front running of tariffs. So, you have those dynamics. You have the ISM services print we got this week, and let me just pull that up here. But that surprised to the upside too. And I think it's indicative that, this is always, we talk about this a lot too, where it feels like, okay, X catalyst happens. Suddenly the economy needs to fall off a cliff instantly and perfectly move in the direction that it should for the equilibrium of wherever we're headed. But the fact is that it's actually, the process takes a lot longer than most always expect. And yeah, it takes longer, and it's not in just a linear fashion. It's two steps forward, one step back, et cetera, et cetera. So we got this ISM services print that jumped up to 51.6, up from like that 9-month low of 50.8 in the previous month. And it's always important to make sure that you're focused on the fact that the US economy is largely service based. So if you're seeing upside surprises in ISM services, it's pretty likely that the economy is still doing okay. Um, you need a pretty big phase shift, which we're only so far seeing in the soft data, and there's no indication of the hard data. So that further keeps Powell on the sidelines. So yeah, it's an interesting dynamic to then contrast with market prices and where those are at.
Yeah, the worst part about that print was much higher prices paid. If you go to that chart I posted in here, I think slide 12. It summarizes, Bloomberg Anna Wong had a really good piece on this. It's summarizing the predicament that Powell's in, because we're getting these, relative to what they were cutting into last year, much better CPI, and with the oil price action of late, you're probably likely to see headline and continue to fall, at least in this next upcoming print. And that is the clear, 180 from all these surveys and kind of forward-looking on anchoring inflation expectations. So this is all the regional Fed surveys for inflation, and that corroborates with the prices paid data. And so they're seeing all this and going to have a really difficult time cutting into that, especially when you look at this trajectory, whether it materializes or not, relative to the 2021 spike. It's starting to look pretty similar. And the next slide shows, the yellow line where there may Bloomberg's estimate for their projections, and the March dot plot, and the economics.
This is basically showing like where the dot plot would be if it would have been a dot plot meeting today, right?
Yeah, exactly, where Bloomberg thinks. And they're pretty hawkish. And yeah, so we just really need to see unemployment spike, or we're just in this holding period. And then I think for market participants, I guess everyone's sort of debating whether or not there's relaxation of tariffs, and that is probably going to influence one's view on how bad the inflation problem might actually be, and what the overall strategy here is. And Powell did allude to this in the presser. He said, there's a number of trade negotiations. If deals occur, we might be able to, change course and take in new information. But that's, I guess, where everyone agrees or disagrees on what the forward outlook looks like. I personally don't believe there's going to be substantive reductions in tariffs, and particularly China, because to me, even if we go from 145 to 60 on China, I still believe the most of those effects are going to be seen through.
What I've been thinking about is just what would take the unemployment rate to surge higher, because that seems to be the one driver that would sort of get the Fed to really get going at this juncture. And you think back to last September, where we were getting those upticks in the unemployment rate, and it became quite evident that, there's some people that are calling out in real time, but it became even more evident that a lot of that was because of uncounted immigration coming into the US. That was basically that increases the labor supply, but it doesn't get counted. So it artificially increases the unemployment rate. And, this was something that even Claudia Sahm, the inventor of the Sahm rule, back then, we were all talking about the Sahm rule trigger. She's a huge Democrat. And even she was saying, fade the Sahm rule here, the thing I created, because it's being offset by a huge amount of immigration. And now we're in the complete opposite situation where you have no immigration at all. So that's probably keeping a lid on the unemployment rate,
Yeah, that's what we talked about. And I've been following this data on the native born versus foreign born. It just keeps striking me, for whatever reason, is a very important piece, because we actually saw it last print as well, where the labor force participation went up. So that's, that means that, as like you said, as a percentage of total potential workers, more were actually working. And so the Fed is looking at that in their sort of vacuum maximum employment picture and saying, well, that's fantastic. And I think there is, like you said, a lot of nuance there, because there was a massive drop off in actually negative in foreign born jobs, and a massive increase in native born. And the data shows there was 2x, we talked about this, 2x the job growth for foreign born in the last few years despite it being, like a 4x smaller pool of workers. So this is a huge thing to be watching, and like you mentioned, could make the data show a tighter labor market for longer than what the actual economy underlying health is.
If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. This episode is sponsored by Arkham, a crypto exchange and analytics platform that lets traders and investors review on-chain data, then take action in the markets. With Arkham Intel, you can see what top traders are buying and selling, and then trade directly on that information through Arkham Exchange. Arkham was built to make blockchains human-readable, simplifying data into meaningful insights for the average crypto user. To start using on-chain data as your edge, go to arkham.com. What stablecoins did for the US dollar, Ondo is doing for stocks, bonds, and more. They're making real-world assets accessible on-chain, laying the foundation for the next wave of financial innovation. With tokenization, Ondo Finance is transforming how financial assets are owned and traded. Discover how Ondo is revolutionizing capital markets at ondo.finance. That's ondo.finance. Restrictions apply. Yeah, so I guess, just thinking more about these like weird extrapolations of data is that, okay, we've had 1 month of month-over-month deflation in the headline print. If where's oil today? It's like $57, so pretty well baked into the headline number is that we'll probably see another deflationary print month over month. So if you have 2 months in a row of month over month deflation, and if that starts to get into like a third month, and you start to see other pieces of the puzzle start to trickle lower as we wait for the real big impact of the tariffs to come forth, and then theoretically, what if the tariff rates actually in those couple of months start to decrease further as well? Suddenly you're in a situation where you have multiple months of deflation and you have the Fed sitting on their hands, and that feels like it could be a spicy situation.
Well, I think that's where July comes in the picture. We're 6 weeks out from the next meeting. Powell emphasized their patience and lack of urgency here. And, as we know, last year, it was August, at about a month before, we knew that they were going to be cutting in September and odds were spiking. And there's just no impetus either with asset prices where they are. Stocks, we'll get into valuations there, but they're priced at very high levels of optimism. So I agree with you. That's the unknown here is I expect this next inflation print to be light. Not that I expect inflation to continue going down in a straight line the rest of the year. But this next one should be light, and there's a chance that the data the soft issues in the soft start to show up in the hard in the next NFP. And then, as you said, you're sort of looking at that. But to me, everybody kind of knows that's the trajectory of things here. They even said, right? They said that the risk of higher unemployment, they alluded that is risen, and so. There's not a ton new between now and June that we don't know other than that data coming through. And it still seems to me like they'll stay on hold because it won't be enough time. But I do think something like that would put July square on the table. But again, we're talking two full months from now. That's like a fair amount of time without liquidity. And what also probably comes around then is when the budget ceiling gets lifted if they get things through. So it's actually kind of a precarious next few months through the summer, which people know the summer to be quieter, but volatility looks like it might be sort of bottoming out here, and people starting to hedge themselves for what could be a lot.
Mm-hmm. Yeah, it feels like basically what we're getting at is that they're setting themselves up for pretty much intentionally being late. I feel like everything we're talking about, they're a million times smarter than us. Like they know these data points through and through. They know this, but they're still intentionally sitting on their hands and waiting for the very last second. And this brings up the discussion of those cuts in the fall of 2024. We were pounding the drum at the time. Everybody was terrified of rate cuts. They were saying that rate cuts were going to be bearish, and that the first rate cut of the rate cutting cycle is
that
when
was
stocks
hilarious.
fall apart.
I forgot about that. Oh my god,
we were ragging on them every week, saying this is insane. When they're proactively cutting, this is going to be incredibly bullish, and we surged that whole fall. But it's the complete opposite situation now. Now you have the labor markets, and everything is in a complete different situation, and they're trying to intentionally be last minute to the move. So it's going to be a larger amount of moves, but at the very last second, that sets up for that classic bearish rate cut dynamic that everybody thought was going to happen in September.
You're spot on. And you can see this in the yield curve. Like the 2s10s has stopped steepening so rapidly as the slower growth pressures from a delayed Fed are building, and you probably don't really see that next leg up of steepening until you get the action by them to support the economy. So there's a lot of we thought the first 5 months of the year, 4 months were fun. I think there's going to be a lot of action coming up because you got the budget ceiling, you got all of that, TGA refill.
Let's talk about how to express all these different ideas in the bond market, because we're both, I know, been kind of talking about what are the right ways to express this, because typically, if you would see the Fed be super hawkish, you would probably see the 2-year sell off and yields go higher as it prices out less rate cuts for the next 2 years effectively. But I think the dynamic that's starting to shape up is that there's a lower likelihood of cuts short term, but probably a lot more medium term, thinking like early 2026. So, I was of the mind going into this meeting that I want to press the 2-year treasury note, because if the Fed comes in super dovish, that's going to rally. The long end will probably sell off because they're pressing super hard dovish here. But if they come in super hawkish, you will probably see a rally in the 2-year anyway, because we need to price in more cuts into the medium term. And you can get very sexy with this if you're trading like SOFR rates. You can hone in on the specific time horizon, because I think it gets to this dynamic of overpricing rate cuts short term, but very, very much underpricing in medium term.
Yeah, I totally agree. I mean, I think, was it last week before we were talking, we were pretty loaded up on bond shorts going into the NFP, and obviously the whole curve repriced higher. We sort of flattened a bit, and we're now at this place where the Fed is slow, and so I think it's natural to expect continued flattening until their rhetoric changes and there's some line of sight to cuts. And probably the best part is maybe, like you said, that 2 to 5 year area, where if you're betting on that's the best kind of part of the curve to bet on for lower rates. Like, I think that the reason I like that front end of the curve here is because you sort of, it's the flight to safety bid if something goes wrong. So that's, margin of safety. And, as we saw today, even though June and July expectations got priced out a big amount, 2 years flat, because it's just the expectations moving further in out the curve. It's not really them yet getting eliminated. I think once the Fed goes to support growth, over inflation, then, that point it'll be the opposite, where you won't want to be in that middle part, because that actually means cuts are being accelerated to the front end, but that means likely less hikes further out, and you get that steeper effect we just discussed. So I think that long twos on the front end until we get more confidence in cuts, and the long end probably just doesn't really do much. I don't think it might drift lower as the front end does, but I don't think it does anything crazy, and everyone's well aware of the supply issues on the horizon. So yeah, honestly, I think fixed income market's been awesome to trade because it's been very volatile with a lot of good risk reward setups, I think.
Yeah, lots to do, lots to express. Okay, as we continue down a route of busting people's Fed hopium, we got to pull up. Seems like this week everybody decided to think that when the Fed shows up at Treasury auctions, that's quantitative easing. And man, I knew this would get Andy Constant going. I don't know if he's listening, but I respect the man for trying to set things straight. So, okay, what happened here is at every Treasury auction, the rate gets set by competitive and non-competitive bids. And that's where basically the yield that these are issued gets struck at. And then once that's complete and the rate is struck, the Fed will come in and purchase treasuries based on the treasuries they own in their SOMR portfolio that mature. They own bonds mature at certain points. As they mature, they're sitting on cash from those proceeds. They need to decide whether to reinvest it into the same existing bonds, just re-rolling it, or if they're doing quantitative tightening, say they're at a $5 billion cap, which is where they're at right now. Previously, that was 25, 50, etc. That amount is the ones that those proceeds get retired. And then whatever's left, there's more nuance to this, but just going to keep it super simple. That gets reinvested, and they do so by buying at these treasury auctions as an add-on afterwards. And basically what happened is that two dynamics happened. So last Fed meeting, we know, is that they tapered QT further. So because of that cap is lower, so they will reinvest more. And then in May, there's just a lot more issuance in general. So that increases the reinvestment further. And for whatever reason, this just took hold of QE hopium Twitter, and just endless takes saying, oh my God, look, the Fed is buying 20 billion, 30 billion at treasury auctions. They're doing quantitative easing. They're not doing quantitative easing. I don't know what gets people so obsessed with this stuff. It really blows away. You could just throw this in ChatGPT. So I think it's just nefarious hopium crap that's engagement bait. And I guess I'm falling prey to it, but it's just insane to me.
I mean, when the general investing crowd has done dozens of buy the dip muscle memory reps for 20 plus years because the government's been there, I think this is just a natural byproduct where buy the dip worked. How do we assign a reason to it? And let's take this fault, just wrong information, spread it. But yeah, I would say it's a good sign if you're relying on incorrect information as a reason to be supportive of your positions here. So take that for what it's worth.
I will say, though, that the one thing is that due to the dynamic of how they retire these, it does end up with more long duration on their SOMA book because of the way they reinvest into shorter duration. So it does end up with longer duration. That's true. But it's not the QE you're looking for, basically. And I feel like you need to do the Jedi mind trick thing.
It's pretty insignificant size relative to the overall issue.
It's literally nothing. It's just So I don't know. Just had to throw that there and set it clear and do my work in supporting Andy and FUD busting all this stuff. Not even FUD busting, just hopium busting.
Yeah, it's actually the opposite. Yeah, it's literally the opposite of FUD.
Yeah. Anyway, got that out of my system, which is all good. Okay, so we got an announcement that Bessent is traveling to Switzerland and going to have the first meeting with China. And notable that he's leading it, not Howard Lutnick, which is interesting. But overall, That came out pretty much right at futures open yesterday from when we're recording right now, and equities popped about 1%, I think, on the ES. And basically, by the time we opened, that had completely reverted. And it's so interesting to think about. This is why I love this stuff, is just thinking through what's priced in the markets versus the actual events. Because if that news headline came out 2 weeks ago, we'd probably see a limit up in futures, honestly, like 4 or 5% or something like that. But because of how much we bounced, yeah, it popped up 1% and gave it all back by the time we opened. And it's so interesting to see. So yeah, Quinn, like, what's your take on what the market is pricing in at this juncture, if that's the sort of reaction we're getting to these clearly bullish de-escalation headlines?
One funny thing, that people are feeling much comfier in their asset holdings if I'm not logging onto Twitter and seeing Howard Lutnick hysteria, which I found actually hilarious. The whole, like, if you know how Trump operates, his whole movie tariff thing, like, who the fuck cares about this, to be honest? And reading between the lines, he's sending Howard Lutnick on a Hollywood movie tariff goose chase while Bessent is negotiating with the global powers on everything that matters. And I woke up and thought, that was the first thing that came to mind. I was like, how's no one cracking these jokes on Twitter? I didn't want to tweet it because I didn't want it to jeopardize my future, role in the Treasury Department prospects. But I thought it was fucking hilarious.
Yeah.
So hopefully Howard doesn't listen to this, but it seems so obvious. Yeah, as it relates to China, I did a poll because I was kind of, I think everybody's been expecting something in the next month. So on Cinco de Mayo, I said, asked what people were thinking, what percentage of the China-US deal was being priced in, and consensus was overly optimistic, which actually was right. It was only a 780 vote Twitter poll of my followers, but it was pretty split. But a lot of people thought it was priced in. And then Brent Donnelly had a great chart here, which is showing how it's kind of a news failure with BABA down, and basically actually what the exact opposite of the oil situation, where we had the OPEC production hike and rumors of another hike, and then oil rallied because positioning was so far offside. So I think, the thing that I have said it a lot on the show is I'd really encourage people to come up with a view as to what it is the administration wants to accomplish, what their objective is, and how they want to effectuate that. Because I still see so much complacency around, when I put this poll out, there's comments like, well, this is too hard to answer because there's such a high probability that he just walks back tariffs altogether. And I'm just like, those takes are just utterly missing the big picture here. Tariffs are not going away. It's something he campaigned on for years. China tariffs are not going away. Trade negotiations and headlines and walking away from the table and playing hardball is not going away. This is not what everybody's getting wrong in thinking this is like just a negotiating tactic. Yes, there's large parts of it that is a negotiating tactic, but it's very much
the reciprocal
also,
part was a negotiation, but the 10% is baked in, I think.
Yeah, and in many cases more. It's not just a negotiating mumbo jumbo. This is their plan. The tariffs aren't coming off, and we are actively restricting supply of the lowest cost goods to the US and going to have to replace those with something else. And by definition, that's going to be higher. So it might cause a growth slowdown, which might cyclically push down on inflation. But there will be other forms of inflation. In that case, shrinkflation. Trump. Girls don't need $30; they can just have two. That's a form of inflation. So, anyways, I just think, yeah, we are getting close. I don't have you would expect another sort of pop like that if we did get some actual announcement. But again, we just had right before Powell spoke today was Trump saying rolling back tariffs. Is it it's a couple days before Bessent's meeting, and he's kind of publicly baiting China. So I mean, what happens if Bessent's in Switzerland and President Xi says, Trump tweets one more time like this and disrespects us, and we're not negotiating? I don't know. Like, I just think it's there's a lot of good priced in and not a lot of bad.
This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the #1 institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure notes, MPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Meet Arkham, the world's first crypto exchange powered by crypto intelligence. Arkham allows you to review on-chain data, see what the top traders are doing, and then act on that information with Arkham Exchange. They've made blockchain data human readable with features like profilers, visualizers, and custom dashboards, making it useful and actionable for everyday crypto users. Arkham believes that transaction analysis, the study of wallet activity and fund flows, will match or even eclipse traditional technical and fundamental analysis. And in a cycle full of hacks, rugs, and scam bundled launches, the best protection is knowing who's moving funds and where they're going. That's crypto intelligence, and that's what powers Arkham. Head to Arkham.com to start tracking wallets, following flows, and trading with an edge. Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big. They're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ondo.finance, and see how they're bringing capital markets on-chain. Restrictions apply. Yeah, I mean, let's go through a thought experiment here. Like, what more could come out that would be bullish than where we're at right now? Trade deal, like I think we got like an agreement in principle yesterday with the UK for a trade deal. And that didn't move markets whatsoever. Like, it just was a complete non-event. Like, what is there? Do you think, like, okay, China tariffs?
That was India's trade deal with UK, by the way.
Oh, India. Oh, okay. That's part of
India, UK. Yeah.
Okay, got it. Okay, but let's say China tariffs go from 145 to 50 tomorrow. How do you think the market reacts?
I mean, same thing. Little pump and probably get sold into, because like
Exactly.
we're back to market peak valuations. So
Exactly.
I just don't understand. Like, if we learned anything from 2018, 2018 lasted the whole year, and this is worse by like
a lot,
orders of magnitude for many other reasons too, where we're at in the business cycle and liquidity.
Where rates are. So exactly. So I don't know, man. Like, you would need to see China tariffs go basically to 10% or 0, I think, to get any sort of meaningful uptick. So, okay, let's paint a picture of probabilistic scenario. So you need that to get probably back to near all-time highs or something like that. And then the downward probability distribution just feels a lot larger, like we're endless amounts of bad. So yes, we've seen the bear squeeze, the short squeeze over the past couple of weeks. But now you think about, and you see it in the price action, like this is always so important, is to look at what happens to price when events occur. And we saw just the perfect example of this with this China headline, where it just completely deflated by open. And that is just a really, really concerning sign to me. So yeah, it just feels like the risk reward is not here right now.
Yeah, I also want to remind people of the other classic Trump move, which is kind of like the pomp and circumstance around every announcement, which it's sort of like, if you have to announce an announcement, the announcement probably is bullshit. And if anybody who operates in crypto knows, that's exactly what happens. Crypto is an industry that announces announcements, and they're always bullshit and sell the news. And what, this whole like, oh, we have something big brewing lead up, and people, maybe retail, I guess, bidding up, oh, they're gonna announce a trade deal with China, I better get my Palantir and my Spotify and my my ARK stocks. Yeah, it's like just setting up for disappointment, and you don't have a liquidity backstop. So I just don't, I don't know what rights the ship. I see a huge left tail skewed probability distribution.
I guess the bull case I could think about is that, okay, we're still running 7% of GDP fiscal deficits. And if you just get a marginal decrease in all those event risks, the fiscal dominance side will take back hold of things, and we'll re-enter where we were in 2023 sort of thing. Yeah, but like so much of that fiscal impulse was state and municipal government spending from COVID. It was a COVID residual, and that is gone now. So to me, it just feels like the only thing left on that fiscal impulse of things is interest payments and like Social Security and that sort of like, and I interviewed Bob Elliott last week, and he was mentioning that we're going to probably see fiscal deficits widen, and it's not going to be the fiscal dominance bull case that everybody has become used to over the last couple of years, because it's going to be automatic stabilizers, because people are getting laid off, like, so that might not be it either. So even that narrative feels stretched to me, but I am willing to entertain it.
Yeah, there's a lot, because we got to see too if what gets through on the tax bill and when it gets through, because there's quite a few stimulative measures in there. No tax on tips, and I don't know. There's been a ton of rhetoric around maybe raising taxes on the wealthy to support tax cuts for under 200K and things.
This chart might help, but it just looks at net debt percentage of GDP in these different scenarios, and so like if the TCJA gets extended, that will be a meaningful increase to net debt. If you add on for those further tax cuts too, you do see this acceleration. So that's possible. But again, if they don't finance this with increased tariff revenues, you're going to start to see the bond vigilantes start to show up, I think, a little bit. And so that's sort of anchoring any sort of expectation of those event risks of increased tariff revenues coming off. So that sort of feels like a lose-lose to me.
The other thing that, I guess there was a few weeks ago, in response to the tariffs, a number of the global central banks became more dovish. We saw a couple, sort of emergency cuts to offset what would be negative economic shocks, being U.S. tariffs to local economies. And that's one thing, I guess, that won't happen in as much going forward, given things are kind of calming. But there's just not a lot to love. I mean, we got the big rotational flows on the equity front as capital went into Europe and other developed and emerging markets. But the next move, which I think over a 6-month time horizon is lower, to me would be sort of everything down together, because that would be hints of a bigger growth problem. So yeah, I don't see a lot of, when I scan through all sectors, all countries and different markets, I don't see a lot of opportunity in the equity markets.
What about Bitcoin? I mean, I've been sort of thinking about and wrote a little bit about how it's a global liquidity asset, and these other countries are starting to stimulate. But then again, when you say that when the U.S. sneezes, the rest of the world catches a cold. So it's not going to be totally immune to that, but I mean, it's been holding up pretty well. What do you think about it, especially relative to U.S. tech equities?
I kind of like anything relative to U.S. tech equities, but that's not saying much because I think there's we should talk about the Taiwan dollar situation and just and some of the implications I think that has. But I view crypto and Bitcoin in particular as that liquidity release valve, and if there's still liquidity coming. I mean, we know that as much as the global central banks, have independence from the Fed, it's the Fed that matters, right? Europe and others were cutting all summer last year, and we continued to get pain. And you're seeing actually gold right now taking it on the chin a bit. It started with the China thing, but has continued today, which sort of tells me maybe gold didn't love that it probably front ran liquidity to a fair amount and now has to walk some of that back in its pricing. So I don't love the risk reward here. I think what I haven't seen a lot of people talk about, but if you zoom out on the Bitcoin chart, this 97 area is a massive exact smack dab center of the distribution of volume.
I've been looking at that a lot too. It's a huge level.
It's exactly what, if you look on the same chart, it's exactly what like that 67 to 69 level was last summer. So yeah, I wouldn't be surprised if we just continue to, if we just repeat last summer again. That's base case.
Yeah, let's talk about the Taiwan thing, because that's really fascinating. And yeah, it's too bad we don't have our boy Tyler here for it yet, because we're starting to talk about Asian currencies. But yeah, man, the Taiwan dollar, just absolutely huge move. I saw some takes that it was basically like there's basically like 2 big days for this big move, and it's been chopping around, I think, since this chart's a little bit old. But overall, like one of those days percentage change was enough, was what you typically see an entire year for this currency. So like a huge outlier standard deviation event. And yeah, to my understanding, it's, once again, this US exceptionalism story of there was so many unhedged flows that are US exposed. And then when you start to hear about a potential US dollar currency devaluation, when you have all these extremely weak Asian currencies, you start to see these stops get run. So to my understanding, and correct me if I'm wrong, but a lot of this was insurers in Taiwan that are, basically just making the assumption, Nassim Taleb will tell people differently, but they assume, no fat tails, I'm not going to hedge my currency exposure. And then you start to get these potential tests of, okay, what would happen if we see a currency devaluation? And then suddenly you get these sort of moves. And yeah, what's your read on it?
Yeah, I mean, I'm no dong expert like Tyler, but I think this is something that did not get enough attention personally. And I don't say that with utter confidence in the specific Taiwanese dollar being the thing that everybody needs to focus on. More so the canary in the coal mine as to what global allocators are thinking. There is problems in over allocation to the US, over positioning in both US equities, Mag 7, and US Treasuries in every foreign jurisdiction. You look at that next slide I have of the Norges Bank, which is the sovereign wealth fund in Norway. They own hundreds of billions of every Mag 7 equity. This is just sort of like tip of the iceberg. But as it relates to the Taiwan situation, this was a bit maybe more treasury focused. There's also huge holdings in Japan, in every Asian country. And Taiwan was keeping their currency weak against the dollar, even despite a very strong economy and surpluses. There was central bank intervention, which is what the non-tariff trade practices that Bessent and Trump allude to that they want corrected. And so the rumors were that I can only speculate why Taiwan was a first mover here is because there's a rising urgency of need for protection in case of a Chinese blockade or invasion. And it's probably a high priority for them to get a security guarantee more firmly locked in. And this is probably one of the things they could do to get that. And so word probably got out. Smart, people close to the inside said, "Oh crap! Like we are unhedged. We need to start hedging our dollar exposure or some of these dollar assets." And that's what happened. And then you see the central bank coming out and say, "Don't speculate on our currency. This isn't what's happening." And every time that happens, it's like when Sam Bankman-Fried comes out and says we're solvent. You just do the opposite.
Or when like the Ministry of Finance in Japan says we're not intervening, and then they come 2 weeks later and said, "Oh, actually, we were intervening."
Yeah. So what I think is the bigger thing here, and if you notice, up until this chip announcement today, Mag 7 and the NASDAQ in general has been really sucking wind.
Google was down 10%, which is insane.
Yeah, on the Apple AI search thing. To me, this is, you can just view it as like everything's overowned, Treasuries and Mag 7, and they just need to TWAP out and make the least market dent as possible because they're really overexposed. And not only are they overexposed, because if these guys are unhedged, you're an insurance company, and if you lose like 5 to 10% of your asset's value in your local currency without even the price moving of the asset, what happens when Mag 7 starts going down 10% again, or bond yields go up again? You're getting double on the chin. And if I'm you're a government, you're Japan, you're Taiwan, you're a big body who's negotiating with the US and who controls your money supply, you can say, okay, I'm going to take this on the chin for a trade deal, blah, blah. But if you're like a private insurance company or like a privately run pension or business or investor, you're not going to just sit here and wait till the Taiwan central bank says, "Oh, yeah, actually, we are going to we are going to appreciate the currency. Thanks." You're not going to let everybody in the world front run you. Now Japan's got to do it. Norway's got all these assets. Like this, basically, if you're an allocator around the world, you're like, wow, that's a lot of ownership of US, and that's not a huge exit door as we've seen when things hit the fan. So I think there's some big signs in Mag 7 and some of these other things leaking pretty hard here.
Yeah, I totally agree. And I think people underappreciate how long this will take to play out. I keep seeing takes where like, oh, it's just a quick rotation trade and out. But the Klausses of the world that Shub always talks about. We had him on the podcast a month ago or so, and they take a long time for those. These are big cargo ships that take a long time to steer. They're not just like a quick little sailing ship that can turn on a dime. And then you start to get them pressed like that when you're taking currency exposure and downside in these equity prices, and especially those that own Mag 7 like you just showed, because to my understanding, yes, there's a lack of hedging in the fixed income space of those that own foreigners that own US treasuries, but there is some. But it's to my understanding that those that own the Mag 7s, the equities, they're not hedged at all, like just absolute minimal exposure. So yeah, that's where it feels like even more so the pocket of risk is even more significant in those Mag 7s. It's a dicey situation.
Yeah, it's hard to know and who's hedged, who's not, but I think there's plenty of flow that isn't. And again, aside from that, I think when you square up the macro outlook, again, aside from this these geopolitical flow issues, I just don't think it favors, we're in a stagflationary environment where the long bond yields and rising, a curve is steepening. That's not a good place for large cap tech. And so we're seeing this finally, some early signs, although it's not here yet, but the early signs of maybe it's, let's say, right sizing monetary policy in a way that's not only favoring the higher for longer, the ATI, those things combined favored, as we talked about, the K-shaped economy, the large cap and tech over small, medium-sized enterprise. If we get these tax cuts, if we get some of these policy changes, deregulation, a steeper yield curve, lower rates on the front end, the policy and the market effects are going to really start benefiting domestic small caps over not necessarily the Russell, because it's a shit index, but that's also very expensive. But small cap value or other things over like these large Mag 7. So there's just a lot of headwinds, in my opinion, for that part of the market.
Yeah, 100%. All right, man. Well, I think we can leave it there. Lots happening. Big secular shifts, but yeah, it's a time to still be, I think, a bit concerned. The upside catalysts are just not all that existent right now.
No, it's a time to be patient. And if you were one of the people who risked your hard-earned capital when fear was flying around and we got 4,800 on the S&P and you're sitting on some nice gains from purchases, it's probably not a bad time to recognize those and go buy your mom some flowers ahead of Mother's Day.
There you go. It's a nice way to land it. Absolutely. Yeah. Call your moms. Don't forget. And have a good rest of the week, man.
Sounds good. You too.